Now let's take a moment to think about venture capital in downturn economies. And maybe a month or two ago, I wouldn't have included this section, but certainly considering COVID-19, it's worth discussing. And so, really every downturn of the economy since venture capital has emerged has ended up in a few down years for venture capital. This is caused by large industries and big customers being disrupted. It's caused by angel investors and other institutions who pull out of the venture asset class. One, because their income has been pulled from losing money in the stock market or other industries that have been disrupted in the downturn. And then also, as you come out of the downturn, the stock market, real estate, other industries are often very attractive because they are being offered at a discount from the higher time prices of the economy. And so investors will shift from investing in venture capital funds at the peak of the market into stocks and bonds as you come out of a downturn. And of course, when the downturn is happening, investors are pulling out of most of the asset classes and investing in cash or gold or other assets that can withstand the downturn. And so just kind of looking at some of the numbers, in the 2001 downturn when 9/11 happened, in the year 2000, you had a record 585 new funds raised, and then by 2003, that number was cut in half to about 200 funds. And that went from $90 billion being raised for VC funds in 2000 to about $20 billion being invested in 2003. And so a significant decrease there in the 2001 bubble. Now shifting to the 08 financial crisis, you see very, very similar things. And so you had 450 new funds around in the 2008 year with about $50 billion raised. And then that within a year dropped to about 390 funds and $20 billion raised in 2008. It was from 2007 to 2008. And so that was not quite as hard of a hit in 08 as in 2001, but we will see what COVID brings to the venture industry in 2021, and 22.